Hello, my name is Andy Barcade, and I'm the publisher of the 401k Compass newsletter. Thanks for taking the time out of your day to listen to our short video on our risk management indicators. Now, hopefully you've listened to our AIA, or our Adaptive Investment Allocation video. And if you have, this video sounds a bit similar to it, but I've added more about the risk indicators. And it's important to understand that the two technologies work hand in hand. The risk indicators and adaptive investment allocation, those two bits of technology work hand in hand to actually run the allocations and the risk management of 401k Compass. So to start off with, we at 401k Compass, the whole idea of our newsletter and the systems behind it and the technology behind it is to help you have a rules-based system, a math-based system to help you allocate and manage your 401k yourself and reap the lion's share of the gains in the good years and be defensive in the bad years. And that's a big part of what the risk indicators are helping us do. We believe in being proactive, not reactive. We really are not a big advocate of the buy and hold approach. The buy and hold is great as long as the markets go up forever, but we all know they don't. Now, we also believe it doesn't make an awful lot of sense to reap the gains, have your account grow in periods of time where the market is increasing, only to just sit there and watch those gains wither away and give a lot of those gains back in a period of market decline. That doesn't make a lot of sense to us. We believe in trying to capture the lion's share of the gains in the good years and become more defensive and back away and kind of sit on the sidelines in times of market distress when the market is falling. And that's a big part of what the risk indicators are helping us do. Now, one of the goals, as you can probably imagine, the main goals of the risk indicators are to basically help you avoid disaster and smooth out the ride of your 401k over the long run, and be, again, as I mentioned this earlier, to be invested or leaning into the market when times look strong, that the markets are going to continue that strength and continue to increase. And in times when the markets look like they're going to continue to fall, to back away and be more defensive and hang on to most of those gains we had in the prior up cycles. And again, the whole idea is to give you the confidence that you are in control of your account, you're in control of your 401k, so you can sleep well at night. To dig a bit more into AIA and how it works with the risk indicators that we have that are tied together and work in tandem, you have to understand stock markets tend to have personalities. They tend to have trends. In a lot of cases, those trends can be identified. They can be positive or negative. The idea of the risk indicators is to analyze the data and the metrics surrounding the market and provide the probability that the current direction, whether it's positive or negative, has a high probability of continuing. I'm going to go into that in just a little bit more. But first of all, some of you have probably heard of Benjamin Graham. Maybe most of you haven't, but he was a professor at Princeton. He's long since passed away. You probably remember his most famous student, Warren Buffett. And Mr. Buffett said that he learned pretty much everything he knows about investment management and investment analysis from Benjamin Graham. Now, Ben Graham wrote several textbooks, and most of them are still being used today. And he said a lot of quotes. And then several of them are quote worthy. But again, this one, if you understand this, you understand the idea behind AIA as well as the risk management tools that we're overlaying our whole program. The essence of investment management is the management of risk, not the management of return. If you can control risk, that will enhance your returns. And that's a big part of what our risk indicators are trying to bring to 401k Compass and to you inside of your 401ks. Now, this chart is literally from 1900 to roughly about 2019. It's designed to show you that markets tend to be cyclical. They tend to have long periods of incline or increase, and a lot of periods where the market is going to fall and decrease or be level for a very long period of time. They tend to be cyclical secular. You have periods of time where the markets literally just bounced up and down for roughly 25 years, had a great increase, dipped, and market, it took literally over 25 years for them to come back. One of the goals of risk management is to be in the markets during these long periods of increase and avoid a lot of those dips. I'm going to bring that more into a rate of return graph here in just a few minutes for you. Dig a little bit deeper. Adaptive investment allocation, AIA, is really about sector and asset class rotation. Again, markets have personalities, which means they tend to favor certain sectors, certain asset classes, certain industries more than others, depending on the economic circumstances at the time. So the goal of AIA is to rank the various asset classes and sectors, highest to lowest, take that information, know that data, and actually, well, here we go. I got ahead of myself. But here's some of the sectors and some of the asset classes that we're looking at. And your 401ks will have within them mutual funds that line up relatively well with these sectors and asset classes. Maybe not, you may not have all of them, but you'll have a lot of them. And the goal, again, of AIA is to consistently or constantly run the technology and the data analysis in the background, do all that heavy lifting for you. You don't have to be worried about that at all. And take that information, and it's ranking highest to lowest, the strongest sectors, the strongest asset classes to the weakest, and taking that information and overlaying it on top of the funds you have available inside of your specific 401k. And then showing to the funds that line up the best with the highest performing sectors and asset categories, and keeping you away from the ones that are being a little bit shunned by the market. We want to keep in the best performing areas at all time. And then we give you a list of the mutual funds and the percentages of those mutual funds to use within an email. And I'll show you that an email or an example of that in just a couple of minutes. And as these sectors rotate, and they do rotate from highest to lowest, and sometimes what's ranking very high now, a few months later may fall off and be one of the lower ranking sectors, but the technology is going to pick up on that and change the allocations it delivers to you for use in your 401k. Now, how the risk indicators work in conjunction with AIA. First of all, there's two risk indicators we use, Compass 1 and Compass 2. Compass 1 is more long-term. It's looking at the market of a more long-term viewpoint. And Compass 2 is a bit more short-term, kind of the canary in the coal mine, if you will. It's important to understand that this information, again, is running in the background. You just delivered to you the result of the analysis. Both these indicators have to be positive for us to be leaning into the market, for us to be in a positive market environment and be invested in stock funds within your 401k. If either one of them trigger negative, we're going to issue you an email alert recommending backing away from the market, because again, that triggering of one of the alerts would indicate that we have a distress coming in the market or continued distress in the market, and we back away and be more defensive and give you the allocations within your 401k, which would allow you to be more defensive and hold on to your gains. Okay, some of the data points that the risk indicators are looking at. Some of the metrics, it's looking at different stocks that are reaching new highs versus new lows. It's looking at different moving averages of different market indicators, different market indices. It's looking at advancing volume versus declining volume, different volume studies. And it's looking at how things rank against each other, how cash ranks against maybe other sectors and other asset classes. This will all give the technology clues to if the current market direction is going to continue. In other words, it's going to give us the direction. It's going to give us an idea if stocks are in demand or stocks are actually being sold off and there's been a lot of supply of stocks. If demand is outstripping supply or vice versa. That'll give us an idea if the market may continue up or it may continue down. Some of the other things it's doing, and it's currently analyzing this data literally every day. And it's judging the probability, as I mentioned a minute ago, the outcome of this data, the outcome of the metrics. It's judging the probability of the current market trend, whether it's either up or down. It's judging the probability of that trend continuing. And it's trying to identify that trend and continue identifying it on an ongoing basis, and then take that data and actually give it to you in a form you can use to either be in the market or then, again, possibly in times of distress, be out of the market. And again, it'll come out in your monthly newsletter. It'll give you the allocations, exactly the ones to use inside your 401k. And if there's some kind of an unscheduled alert, which would indicate the risk indicators are are flashing there may be trouble continuing or trouble around the corner, we'll issue an alert to be a bit more defensive. And here's some of the charts that'll kind of give you an idea how it's worked together. Now, again, I have to say this before I jump into these charts. This graph, these charts don't indicate or don't represent any one individual 401k. They're made up of exchange-traded funds, which would be similar to what is available to you and your 401k. Now, keep in mind, everybody's 401k is different. One company is going to have a slightly different 401k than another. You may both have growth funds. You may both have mid-cap and small-cap funds, but they may be different. They may be from different companies. Hence, the funds are still similar, but there are some differences, so the returns will also be different. This is just kind of designed to give you an across-the-board representation of what your 401k might look like. Now, this is a level 3 risk level. And if you listen to the AIA video, I explained a bit about how the risk level questionnaire works. 1 to 5, 1 being very low risk, very conservative, 5 being higher risk, 3 is somewhat in the middle. This is a moderate allocation, and this is only using Compass 1 as an indicator. Remember, we have 2 risk indicators, Compass 1 and Compass 2. Compass 1 is long-term, Compass 2 short-term, and they work together. This is only using Compass 1 to kind of give us an idea of how they work together and what the difference in return is, and the difference in volatility control. Using them together will supply you within our newsletter. Now, just applying or just using or applying Compass 1, the black line or the dark gray line is the S&P 500, going back from 2001 to 2020. It had a pretty good rate of return. Its rate of return over that period of time was just shy of 7%. If we look at these 2 boxes on the top right, you'll see in the second box, the rate of return over that period of time was 6.96, just about 7%. By applying just the Compass 1 risk indicator, our rate of return increased to 9.6. In other words, our rate of return, if you had $100,000 at the beginning of this period of time, 2001, left it in the market, it'd be worth $377,000. If you applied just the risk level 1 indicator, Compass 1, that money increased over $600,000. Actually, let me move my screen here, $617,000. And its rate of return went up to 9.6. But I think what's more important to understand is the risk control it provides. If you look at that second graph, the one beneath it, the loss exposure profile, you'll see that shaded dark area is the volatility the S&P had, and that blue area that's above it, that's the volatility that the moderate growth model had using AIA and only Compass 1 as a risk indicator. And again, you see, by staying out of the market and by being in the right areas as the market rotates, you have a much better rate of return and a lower risk profile. If you look at the box on the bottom right side, it's a red box. It's called maximum drawdown, which is what drawdown is a definition. It's the dip the market took, the drawdown that it took from peak to trough. So the biggest drawdown, the biggest loss from top to bottom over that roughly 20-year period that the AIA moderate growth had using just risk level or just Compass 1 as a risk indicator was 21.7%. The market over the same period of time, the S&P 500 fell over 55%. So just applying the one risk indicator, the long-term risk indicator, your volatility was cut in more than half. But now, having said that, the next slide uses both Compass 1 and Compass 2. And you can see very quickly, there's a decided difference in rate of return and risk control. If you look at the rate of returns in the top right-hand corner, our rate of return went up from about 9.6 to 12.6. The growth went from the market providing a 7% return, or roughly $100,000 going to 377. Applying both risk indicators to the moderate growth model, you've returned you more than $1 million. So it went up tenfold over that period of time. That's a 12.63 rate of return over the long run. But if you look at down at the maximum drawdown box, the red box in the bottom right-hand corner, you'll see that the maximum drawdown went from 21 down to 9.9. So by applying Compass 2, which is a shorter term risk indicator, with Compass 1, we reduce risk, reduce volatility even more, which is a big reason why the growth was enhanced. So both these risk indicators are used, they're applied, they're overlain on top of the AIA technology. That is all applied to you and given to you in your monthly email. And again, I'm just trying to explain this, all this number crunching, all this data is being worked on behind the scenes, and you're being provided the outcome of that in a simple email. And I think I've got those right here. Yes, the next slides are about the emails. This is an email you would get as a monthly newsletter allocation when we were in the market, when the market looked like it was going to continue to go up as judged by the risk indicators. This person was a level 3, kind of a moderate risk. And you see, in this case, there was 2 401ks, a 401k and a 403b. This could be a husband and wife, one working at one company, one working for the other. Or we can supply you the email or the allocations in one email. And again, the cost is the same for one of you or both of you. So it's not a doubling of the cost. We're trying to keep things affordable. In this case, it's showing you if we're in the market and you are moderate risk, you'd be about 60% in the market and 40% in cash. And these are the 2 mutual funds to be in, as well as the Dignity 403b, the same allocations and the same allocation to cash. And you can simply now take that information, go to your 401k's website, and make the appropriate adjustments, and then go on with your day. And then look for the next newsletter a month later. Now, if the markets did experience a period of distress or volatility, and the risk indicators triggered, you'd get an alert. That alert is unscheduled. It happens whenever the risk indicators trigger. It could be the first week, it could be the second day of the month, right after you got the initial monthly newsletter for your allocation. If things got volatile, it could trigger. And again, what this is showing is if the market's going down and the indicators are assessing that downtrend will continue, it's going to back out of the market and be in something safer. It's going to put us back more into cash, more into bonds. So what it's showing here, if you remember, we were about 60% invested in stock mutual funds in the good market, in an increasing market. But as the market triggered a potential continuing period of decline, the risk indicators triggered, and it's showing us to going back to about 88% cash, which is decidedly being more safe, trying to pull a lot of the chips off the table to be safe, to hold on to our gains. And you can take that information, go right to your 401k's website and make the updates. So again, I hope this has helped. I hope this has explained how the risk indicators work. And I always tell people, if you haven't already requested demos or live phone calls, do that. You'll talk to a live person. You can ask your questions. We'll explain more about AIA as well as the risk indicators. If you need that, just to make them sit a little bit better in your mind so you understand how they'll be used. And keep in mind, we're doing all that work. We're just supplying you the outcome of that so you can apply it to your 401k. So again, please avail yourself of those live demos. It might even be with me. And again, thank you for your time. Thank you for your interest in 401k Compass. And I think you can see that for the cost of this, it's a tremendous tool to help you continue to have your financial situation bettered and actually continue to make your life easier as well. So thanks again. Enjoy the rest of the day.